How's it going, friends and family? And I guess we should introduce haters to the mix, because it's come to my attention that there's quite a few people that hate watch the content. You're welcome as well. Anyways, everybody gets it, okay? Whether you love or hate them, Amazon prints cash. Now, after their most recent earnings, the market punished them pretty hard. Even leading up to the earnings, they were going on a sell-off, but right after the earnings, they fell off the cliff, right? For a Mag 7 stock, I guess this isn't unusual because even Microsoft experienced the exact same thing. So at this point, this market's really irrational. Past 1 year, negative 12%. So you would think a company that's being punished like this, they would be a dumpster fire that's unprofitable and they're just burning through cash. But friends and family, that couldn't be further from the truth. Like a quick trip to Costco, right? At a minimum, if you take your lady, you'll spend an hour in there. Me personally, I like going to Costco. I like a good bargain. I like a good deal. But when it comes to Amazon, was this the right call by the markets to punish them this harshly? On one hand, yes, they missed the bottom line expectations because of a one-time legal settlement, and they had to do severance payouts because they're doing layoffs. But on the other hand, their gross sales, it topped the estimates. AWS revenue was up 24% year over year. Digital advertising revenue was up 23% year over year. And they're still, pound for pound, the most diversified of the Mag 7 with all their various business endeavors, whether that's a good or a bad thing. All right, hang in there. We're going to get to the meat and the potatoes like we're a Polish family. Why is this happening? Why is Amazon selling off? Well, it's because of the capital expenditures. I'm going to shorten it and just say capex. Now, capex, it's the money that you spend to build out physical infrastructure like factories, data centers, manufacturing facilities, robotics, and everything to support future growth. And based on the most recent round of earnings, just looking at the Mag 7, right? We know that Meta's spending about $135 billion on capex. Google's spending about $185 billion, and Microsoft, for the full year, it's estimated at about $150 billion. Now, this is where it gets crazy, okay? Amazon whipped out the biggest dong of the bunch because they said they're going to spend $200 billion of capex. And in case nobody has told you, capex, it directly erodes the free cash flow potential, which means less cash profits going into the pockets of Amazon. And from my understanding, Wall Street, for the most part, they hate capex because they're short-sighted, they're impatient, and they hate seeing that there's going to be less cash printing because you're allocating the cash into reinvesting it and building out physical stuff. But I feel like it's the same pushback that investors, hedge funds, and Wall Street had towards Walmart in the 1980s and to Amazon in the past decade for spending so much freaking money in order to build out their supply chain and logistics infrastructure. But because they did that, it's the reason why they're both best-in-class retailers. You can't touch them. They're the king and the queen. One can argue which one is the king, but whatever. You spend money up front in order to develop a strong economic moat for the future. Now, my previous life, I worked in strategy for a pharmaceutical company, but I also worked in supply chain. And I understand from firsthand experience, wink, wink, how strong the Amazon supply chain infrastructure really is. But then again, I get it. I understand why Wall Street's overreacting because Amazon's going to be sacrificing their short-term profits with the crap ton of capex, so investing into Amazon right now, it's betting on their future ROI. So where exactly is the capex going towards? Well, Amazon's leadership, by the way, when we talk about Andy Jassy, I feel like out of the Mag 7, I think an argument could be made for Microsoft, Sundar Pichai, but Andy Jassy, so uninspiring. Zero charisma, and that might be an unpopular opinion, but the Amazon leadership, team, they have said it time and time again that their bandwidth as of right now is completely tapped out. So they're literally getting in their own way of furthering growth, unless they open up more data centers to accommodate the customers' growing needs. And that's why the capex on paper makes every sense in the world. Because each data center, it can only support so much cloud infrastructure and AI endeavors. And once you hit that ceiling, you're effectively throttling your gross sales. You literally cannot make more cash unless you charge each pre-existing customer more. But right now, growth is the name of the game. That way you can take more market share away from Azure and from Google Cloud. And that's why Amazon said they're going to be spending a majority of their capex on AWS expansion. And I don't know. I think on one hand, when I think about $200 billion of capex, that's pretty terrifying. But I think their backlog kind of warrants it. I think they said it's somewhere around like $240 billion just with the AWS backlog. So that's why they're justifying that we have to build it out so that we can make more money. It's like, have you ever been to a family-owned restaurant that closes early because they run out of their special dish? Like they make everything in the morning and then when it sells out, it sells out. You ever been to one of those before? Hands down, if you go to their Yelp, or I guess now their Google reviews, it'll usually have the best feedback from the customers like, dude, this is the best whatever I've ever had in my life. So quick story time, when I used to live in Korea, there was this pho spot that made all of their broth in the morning, and then they stayed open until every last drop was served. You would imagine they would have to stay open late? No. Most days, they usually close their doors by 4 or 5 p.m. Now, what's really frustrating is that I would show up at 3 p.m. after working out to get some of that pho in, because pho is so good for your body, right? It has protein, it has a lot of collagen from the broth itself, and it fills you up, and it's a really healthy meal, especially if you're sick or if you're trying to overcome a hangover. But for me, back in the day, I used to do bodybuilding. It was a great way to hit my macros because I would also get extra beef in the soup. But anyways, I would show up at like 2:30 or 3 p.m. I would stand in line, and then by the time it was my turn, there was literally no more product because the restaurant was like, hey, we're done. We're closing our doors. But looking back, now that I'm a little older, I think it's a perfect example of a family that's prioritizing their work-life balance. Because why stay open longer to feed idiots like me when they can enjoy their time off because they've already made enough money for the day, right? So when I think about the restaurant, their P&L looked good enough to not make more broth and increase profits. But imagine with me right now how much more money they would make if they served pho until 9 p.m. or like most restaurants in Seoul, 10 p.m. That's how I think about Amazon. More data centers, it simply means that they can stay open longer and serve more demand that already exists. They've got the demand. It's just the supply. There's not enough of it. Their bandwidth completely tapped out. But it's not just for the data centers and AWS. The capex is also going towards their own development and in-house AI chips because they're tired of paying the NVIDIA tax. Because everybody knows that NVIDIA's chips right now are best in class, but to get one of their chips, you have to pay a very pretty premium. And as we've witnessed with Apple and Google, going with building your own chips, I think in the short term it sucks because you're going to be spending a crap ton of R&D and I guess SG&A in order to poach employees from NVIDIA, AMD, and whatnot, the ones that don't have an NDA. But in the grand scheme of things, it's the correct route. Once you start making your own chips, your overhead costs and your margins get so much optimized and so much better. Although I will say for chip makers like, Skyworks Solutions, it's a sad thing because once you sever that partnership with some of these chip makers, that's all they make, right? And once you say we don't need your design anymore, their revenue and their bottom line takes a huge hit. And what else about their capex? Now, I don't have an opinion on this yet, but they're also allocating about $10 billion out of the $200 billion of capex towards their LEO project, which are the satellites that they're launching into space in order to fight with Elon Musk's Starlink to provide telecom, internet services, and whatnot. So I don't really know if that's going to have a good ROI. Some people speculate that space is the next big gold rush. So I guess time will tell whether or not it's a good venture. But for me, I'm thinking the data center lens, I think that's absolutely a good ROI. So you guys tell me. Do you think the sell-off is justifiable, or is this a buying opportunity? I will say this, okay? As an Amazon shareholder, I'm not selling. Matter of fact, I could absolutely be wrong, but I'm personally choosing to double down. I'm not saying that you should double down. I'm not saying that you need to copy me. It's just what I plan on doing. I'm saying this from a pretty bullish lens. Now, if you don't, put me on. Let me know why this is a terrible idea, of why Amazon spending $200 billion is a red flag. I mean, yes, I can see it on a financial P&L sense. In the short term, it's not going to be good because Amazon right now, they're willing to sacrifice profits in order for future durable growth, which as a guy that likes to think long term, I agree with that horizon and strategy and game plan. Let me know. And of course, I'm not going to leave you hanging like that. We are going to be taking a look at their updated numbers together. I'll add some color and commentary to what I am saying. Fiscal year 2025 data is now updated. If we break it down on a quarterly basis, I mean, for a company where their market cap is $2.2 trillion, to still be able to grow their top line, why is it called the top line, Amos? Because the gross sales is the first thing that you see on their P&L, which is the income statement. To still be growing at 12.4% year over year, I mean, that's still really impressive. I think people forget about the sheer size and scale of Amazon. To be able to increase your gross sales by 12% is really, really impressive, especially when we're talking about revenue of $700 billion. Right? This is not millions. This is not thousands. This is not like chump change. They're generating $700 billion. I mean, to put it into perspective, in 2016, it was $135 billion. To go from that to $716 billion in a matter of 10 years, dude, simply amazing. Take a look at their bottom line per share. Now, Amazon might be the worst example to do this with because fundamentally, it's a company that's willing to sacrifice short-term profits in order to increase their economic moat for the future. But having said that, I mean, it's still going up and to the right and in the right direction in the grand scheme of things. Jump on over to their cash flow statement. This is what I want to specifically call out. When you take a look at their capex, right? Prior to this year being $200 billion, the highest their capex has ever been is $131 billion. Prior to that, I mean, it used to be pretty manageable at like $13 billion in 2018, $40 billion in 2020. So I guess the sheer aggressive growth of how much money they're spending, it is kind of concerning, but at least this right here is backing it up. Right? If the gross sales were stalling and this was their last dance and their back's up against the wall, of course, I would be frustrated. I'd be like, dude, this is stupid. What are you doing? Like Oracle's a perfect example where their revenue growth is stalling. It's stagnating. And that's why they're going all out into building out data centers in order to support OpenAI. For them, it's a make or break. To go all in for OpenAI like that, it's kind of concerning, right? But for Amazon, dude, they serve almost every customer that you can think of, enterprise, organization, S&P 500 company. A lot of people do their business with AWS. When we take a look at the revenue situation for all of their various lines of business, every single one of them, except for other back in June of 2024, they're increasing and they're growing and they're scaling. Not any one is stagnating or declining as of the past 12 months. AWS, think about their e-commerce platform. When we talk about digital advertising, everything is smashing. So when I hear the leadership say like, dude, we could make so much more money, but we don't have the capacity to do so, For me, that's where I'm like, I bless off on the capex. I'm like, do what you got to do, baby girl. Do what you got to do to make more profits in the future. And before we get ahead of ourselves, what's their debt situation? So their debt to EBITDA ratio is a 0.94. So utilizing their own core operating profits, it would take them 11 months to pay off all of their loan obligations on the books. So I don't care how big their total debt situation is, knowing full well that the golden standard for the debt to EBITDA ratio being a 3 and they're at a 0.94, absolutely sustainable. So you might see this and say, oh my gosh, I cannot go near Amazon. I'm allergic to them. As a matter of fact, I'm racist. I don't like Amazon. You can say all that ridiculous stuff, and because their total debt is $152 billion, but that's why you put it into perspective in comparison to their own core operating profits or their own cash flow, and then you quickly figure out, like, actually, it's not that bad. There's some people out here where when they see debt, they run away, because they don't understand that most businesses, most real estate conglomerates, or people that have made a lot of money, you have to spend money to make money. And in best case scenarios, leverage and loans in order to triple or quadruple your growth or your expansion, as long as it's sustainable. Obviously, I'm not advocating for people to go on margin, to trade, day trade going on. No, do not do that. But what I'm saying is if you're generating $700 billion of revenue and your total loan obligation is $150 billion, dude, nothing. Especially with the debt to EBITDA ratio confirming that it's safe. I like what I see, right? Now, speaking of which, what is their ROIC? A 14.6? Pretty good. I mean, I wish it was like 2018, 2020, where it's about 28%, 20%. To see it be on a downward trend, not too happy, but at least it's above that magic number of 10%. Return on equity, 22%. Return on assets, 6.9%. These are just decent. I mean, this one is phenomenal. This one's just okay. Now, obviously, if you're an Amazon employee, you probably have a different opinion than me right now. You're probably pissed off because your RSUs that are vesting, obviously, you would want to see it be increasing, not be freaking negative. And before I sign out of here, I wanted to circle back to my 2026 top stock picks portfolio. Year to date right now, 14.6% into the green. I think it's kind of hilarious. $100,000 spread across these 12 positions is now $114,000. I mean, the military stocks are obviously crushing it. Mercado Libre and Amazon, obviously the ones that's kind of suffering. But the biggest eyesore is right there at United Health. They're at a negative 16%. But because the portfolio is diversified, in the grand scheme of things, $114,000. So from time to time, I'll keep circling back to show this portfolio because it's interesting, right, to see the development. And even though silver and gold has had a pretty big pullback in the past week to 2 weeks, they're still in the green. 9% for silver, 15% for gold. So, if I were to had start a brand new portfolio and I copy this on January 1st of 2026, I don't think I would be too upset with 14.6% for only a month plus 1 week, so like 5 to 6 weeks. That's not bad at all. Because for most people, like especially the ones that hate me, you probably get a ROI of like 14% in a single calendar year, right? Like the other day, I uploaded a video showing my total return, and my gosh, the amount of haters. They're like, nah, dude, your CAGR does not count. Your total return doesn't count for XYZ reasons. And it's like, oh my gosh. Which is pretty funny because as the folks on Patreon understand and know, I buy and sell out of positions pretty frequently. So the CAGR that you see in my Dividend Compounders with Cheese portfolio, it's gains from capitalized profits from what I have sold out of for the most part. Yes, there are some holdings that I'm just holding on to, but for the most part, I sold out of Microsoft, Google, NVIDIA, AMD, and I capitalized on those profits. It's not paper gains. Now, as a guy that used to work in ministry and did a lot of therapy and counseling for folks, one thing that I've noticed is that when you are doing better than someone else, it evokes negative emotions for the insecure. They start hating on you, making fun of you, or they start throwing weird language towards you. So I don't know what the situation is on why I have hate watchers, but it is what it is. However, I don't want to focus and think about the negatives because I know there's a growing community of people that resonate with the content that I'm producing, and I know you guys are good folks, so I appreciate you. But anyways, let me know your thoughts on Amazon. Let me know your thoughts on the 2026 portfolio. And having said that, I'll talk to you guys really soon. See ya.